We live in an era where you can finance a burrito. People are literally taking out loans to pay for late night fast food and rideshares. Nearly 1 in 5 Americans now uses a buy now, pay later program, and almost a quarter of those users have missed a payment in the last year. Unlike a standard credit card, which acts like an open tab at a bar that you pay off at the end of the month, a buy now, pay later transaction is completely isolated. If you buy a pizza, that is one distinct microloan. If you order dessert, that is a second microloan. Curious, the companies issuing these loans, places like Klarna and Affirm, aren't actually banks. Legally, they operate as software companies, existing entirely outside the heavily regulated U.S. banking monopoly. If they aren't banks, and they are handing out millions of pay-in-4 loans with exactly 0% interest, so how do they stay in business? The seamless checkout screen functions as a highly engineered interface designed specifically to obscure the financial reality of the transaction. When you pay with physical cash, you feel an immediate psychological sting. The item you buy has to be worth that temporary pain. Retailers wanted to remove that feeling. They started with paper checks, letting you write numbers instead of handing over cold currency. The sting was reduced. The credit card removed the pain entirely. You could swipe a piece of plastic and your bank account balance wouldn't drop until weeks later. Buy now, pay later is simply the latest iteration of this psychological trick. By showing you a checkout price of $25 today instead of the full $100 you actually owe, your brain perceives a massive discount. You spend more, simply because the total math is hidden. Because these apps aren't banks, they don't have vaults full of cash. They operate strictly as matchmakers, quietly linking you up with massive, unseen Wall Street capital providers who actually have the money to lend. This animated flowchart shows exactly how that works. The software app sits right in the middle. It finds the consumer, but it relies entirely on the capital provider on the right to wire the actual cash across the screen and into the retailer's hands. But look what happens when we add the costs. Capital providers don't hand out millions of microloans for free. They charge the software app a steep origination fee just to write the contract. Those fees are completely crushing the middlemen. Klarna loses roughly 24% of every single purchase strictly to origination fees. A firm burns a full fifth of its total operating expenses the exact same way. The entire zero-interest illusion is mathematically broken. These tech platforms are actively bleeding cash every single time you hit that final checkout button. To stop this bleeding, these companies have to cut the Wall Street capital providers out of the loop entirely. And the only way to do that is to start hoarding their own massive piles of cash. That is why Klarna recently launched its own debit card. By funneling over 1 million users into their internal banking ecosystem, they can hoard direct deposits and lend out that cash without paying a middleman. But cheap cash isn't enough to reach profitability, so the 0% interest promise has quietly vanished. Today, these platforms will gladly let you extend your payments over time for a fee that can reach a punishing 36.99% interest. By drawing users in with free plans and then offering high interest extensions, Klarna has turned interest charges into its fastest growing revenue stream, up 244% in a single year. Their path to profitability now relies on a model sustained by this long-term high interest debt. With delinquency rates climbing, what happens to the global economy when millions of consumers suddenly default on their burrito and concert ticket loans? On the left is the entire buy now, pay later market at $128 billion. On the right is the total U.S. household debt market, a towering $18.8 trillion. Housing debt makes up 70% of that tower, making the microloan market mathematically insignificant. Even if every single one of those short-term digital loans defaults tomorrow morning, the broader macroeconomic system isn't going to collapse. The real danger is far more personal. While Wall Street institutions repackage these microloans into massive insulated pension funds to avoid the fallout, the individual consumer is left holding the bag on Main Street. Because these platforms issue isolated, singular loans instead of open, revolving lines of credit, they actually damage your long-term financial standing. Once you pay off your fast food order, that specific credit account permanently closes. The age of your active accounts makes up 15% of your overall credit score. If you rely on a constant cycle of opening and closing short-term microloans, your credit age stagnates and your score refuses to grow. A flatlined credit score has severe real-world consequences. It means getting rejected for apartment applications, being denied auto loans, or suddenly finding out your monthly car insurance premiums have doubled. These platforms have engineered a system that finances corporate survival by quietly liquidating the consumer's financial future, one tiny payment at a time.